Hello, Nonprofit Quarterly community. My name is Jean Bell, and I direct the Advancing Practice program here at NPQ. I'm so glad you're with us for Shaping Your Ask, Learning to Love, or at least Live With, Restricted Revenue, a topic that we've covered in so many different ways, and I'm so excited to have Kurt Klotz here, who many of you follow, to talk about how the FASB changes of late can cause new strategic choices in presenting a case for restricted revenue. Our sponsor today, which is why we're able to bring this content to you at no cost to you, is AccuFund. You see their logo on the top of that slide. AccuFund is the financial management ERP software nonprofits have relied on since 2001. AccuFund's fund accounting solutions deliver powerful dashboards and analytics, revenue restriction capabilities, and FASB ASU reports to nonprofits who understand that transparency and accountability begin with sound financials. So we're grateful to AccuFund for their sponsorship. You also see a hashtag in the bottom right there. We hope you'll join us on social media as you comment on what you're learning and hearing in today's session. The hashtag is #ShapeTheAsk. And you also have a questions box, which is where you should write in your questions as they come to you. We expect that Kurt will speak for about 40 minutes or so, and so we'll have a good 15 minutes at the end to engage in dialogue. So go ahead and enter your questions as they come to you. I'll catch those and moderate Q&A with Kurt towards the end of the session. So let me introduce Kurt. To some of you, he needs no introduction, but Kurt is a CPA who serves as Director of Nonprofit Innovation at CLA. This role is grounded in CLA's nonprofit consulting and business operations practice, which inspires Kurt's writing and thought leadership in the industry. He's a primary contributor to CLA's Innovation and Nonprofit Finance blog. He often writes for NPQ, and in 2016, he wrote a piece called A Graphic Revisioning of Nonprofit Overhead, which is one of the most read and shared articles of the last few years at NPQ. So in some ways, I see this work kind of building on that, this continued support to our thinking about how do we understand our own economics and how do we present it to our funders in ways that are strategic for us. So we're so excited that you're here. We know that this work is based on some writing you've already done. We're going to share that article with you at the end of the session, but excited to bring this content to our community. Kurt, thank you for being here, and let me turn it over to you.
Thanks very much, Jean. It's a delight to be here, and hello to everyone who's listening in and watching in today. I want to thank Jean and the whole Nonprofit Quarterly team for inviting me to be a part of this webinar. I have a great time running around in the field that I do in nonprofit accounting, trying to match those accounting principles I learned with great work that we do in our missions that we push out into the world. So this is just another chance for me to talk about that a little bit, share some things I've stumbled across in my work. But what we're here today to do is really to talk about some of the new FASB accounting standards, which I know may surprise you that we're going to talk about accounting standards and fundraising together, but I always pride myself on looking at, and maybe being maybe too much pride, and trying to be a little bit of an edgy accountant and trying to look at ways that accounting standards, those things that we might in the past sort of think of as rules or regulations, actually just as another opportunity to be strategic about the way we do finance in the nonprofit world. So we're going to look at those accounting standards, though. I want you to know enough about them to use them wisely, but also then to start applying those accounting standards to our grant and proposal writing, which is sort of the focus of today's webinar, and to come up with some strategies and approaches that help you really consciously shape those proposals, those asks, in a way that makes your funding more flexible when you receive it. Next slide, please. And really, the sort of premise I'm starting on is that we all live in a world of restricted funding in the nonprofit world. We talk about it a lot, sometimes see it as a burden or a hindrance to our work. And really what I've started to realize in my work as a CFO and my interaction with development officers and CEOs and actually auditors and other nonprofit folks is that sometimes our restrictions are our own making. And really I want to address that today, is that in all those ways that our proposals, our asks, our websites, anything that we put out into the world that asks for money really shapes the donor intent that then rules the restriction on that money after we receive it. So really, to try to get ahead of that, I'm hoping we can talk today about ways to make sure that it's our ask, our proposals, our budgets that are well crafted, and try to avoid restricting ourselves in ways that might not be necessary. And really, I mean, I think you all have had your own experiences with this. I certainly have, as a CFO and being around nonprofits really for the last, well, actually my entire career since college, so about 35 years, 25 years of that as a finance professional, is that we've all run into those situations where we've gotten restricted funding that's come into our organizations, and either, because of the way that the grant was written or the proposal budget was written or the restriction put on it by a funder, we find ourselves in these places that the grant doesn't seem to be that effective for us. Or maybe sometimes we can't actually spend all the money that we got for a particular project because it's so narrowly tied to just that one project, and we don't even sometimes have the capacity within our organizations to spend all the money that we got. And sometimes we know that we have been tempted and sometimes gone out for restricted grant money that's actually outside of our mission, chasing the money sort of thing. So we've all had experiences that we'd like to avoid again in the future. So really, one key point I have today about how to avoid that situation is start with full collaboration, right? You can see my little tagline at the bottom down here. It takes a whole nonprofit to raise a fund, right? And that's been one of my key learnings as a nonprofit professional, and certainly in trying to always bridge the gap between finance and mission, is that when we're all working together, when we have our CEOs, our CFOs, our program staff, our development directors all aligned, we have the best chance to make sure that the work we do is covered by how we ask for it. If we're all aligned there, we have the greatest chance for success and making our proposal budgets, our proposal narratives line up with what we really do. And in that case, it doesn't matter if there's a restriction or not. If we're paying for what we do, that's a good thing for our organization. So really, one of the first strategies I'm going to propose may seem like sort of a no-brainer, but unfortunately, I find more nonprofits are not still suffering from not doing this. And really what I'm talking about is that developing a full cost proposal budget. And the reason I say full cost is, and you may hear about it as true program cost, full cost, fully loaded proposal budgets, whatever terminology you're using, we would surprise ourselves at how often we don't actually ask for everything we need to complete a project. And as you can tell, subsistence is not a good financial strategy in my mind, so I would rather see us bringing in money to support the full cost of our operations, not just part of it. So what's a full cost proposal budget look like? This is where I like to think that we need to challenge ourselves to not be timid in what we ask for. I think that we all know that our funders actually want us to succeed, right? They're investing in our work, they're supporting our work because they actually have some strategic priorities themselves, some goals for the world, for their work, for the programs that they choose to fund. And really what we need to do is give them the biggest chance to be successful in their work by offering them a budget and a proposal narrative that actually covers the full cost of what we intend to do for them or with them. And so really you can see here some of the things that I see as essential to that. I mean, one, if you're going to actually build a line item budget, and I'll talk about other alternatives later, but if you are going to build a line item budget, include all the items. I mean, seriously, think about it. Include everything that it takes to run that program, but especially to run it within the context of your full organization. So I always challenge people to include other costs that we sometimes are timid to put in there and afraid to put in there, or think that our funders won't like, or think that the prevailing world out there is that somehow against the fully funding our work. But think of things like the cost of key infrastructure. So that Gene mentioned that post that I did with Nonprofit Quarterly a few years ago on revisioning nonprofit overhead. What that really did was put these core costs at the center of our organizations and the center of the way we think about them. So let's ask for those costs too. So we need to allocate things out in admin, fundraising, communications. We can also build reserves into our budgets. Believe it or not, you can build in a line that shows you're provisioning money to an operating reserve, provisioning money to an opportunity reserve. Those are legitimate things to build into a budget. Now, it helps to have a relationship with your funder so you don't surprise them with them in the budget, but those things are legitimate ways to build the financial health of a nonprofit. And then finally, really just the bottom line in all of this is always budget for a surplus one way or another. Either build it in the line items, but never a zero bottom line. That is not sustainable. That is only subsistence. Next slide, please. So really, the way that I sort of tie then that budgeting idea to the narrative piece is that we always should be writing our narratives to and building the budgets to capture the largest view of our organization possible. This is a principle that I would actually start with the finance folks with, and in collaboration with program and the CEO, is really to build the finance system to capture the largest buckets possible. If we're going to build out an accounting system, let's make sure that we start by sort of dividing our organization up into those largest organic pieces possible, meaning what is the largest program for the division that we work in? And if we build our budgets and our proposals to go to that largest place, even if they get restricted to that one program, if it's an all-encompassing program, it works better in our fundraising. So really, let's take an example, and I'm going to show you a couple different examples through this slide presentation about how to actually work this same organization and this same program that they're making a proposal about into a couple of different budget formats. But here's my example. It's a civic engagement organization. They're going to provide 10 educational workshops about city government. They're going to have 2 guided tours of the city council meetings. Their budget asks for $100,000, and the budget's going to be designed to fully fund the work. So not just the narrow direct cost view of this, but to fully fund the work, everything that's entailed to get this project done. So here's that budget. And you can see I've highlighted a couple of areas that might be new to you or things that we haven't always done a good job of conveying to our funders. But we have the usual line items. So if you are going to limit yourself by having a line item budget, and the reason I say limit is because as soon as you write this out in budget form, in line item form, and I realize we're in a world where some of our funders are going to require this, especially government agencies. Some more traditional funders may require this sort of a budget presentation. But if so, at least you have a chance to have the conversation up front. Even if they say no, you're going to do your part to sort of be an advocate for this way of thinking. If you present this budget first and then work back to what they're absolutely bare bones of what they'll fund. But you can see that I've included those more traditional line items, everything from personnel to program-specific materials. Those are in this budget. But below that, I've added core admin allocation and a core fundraising allocation. Those need to be built into your accounting system. You can't just make those up. You have to have a sophisticated enough view of your organization to capture what the proportional costs would be for this program, but you can include them there. And then you'll also see I've gone even so far as to include down at the bottom a provision for an operating reserve and a provision for an opportunity reserve. If your strategic planning and your financial planning include those kinds of moves on your part, include them in the budget. That's an important thing for everyone here. So one of the things I want to say about using accounting standards now. So there's my first example, right? Now that's just a full cost budget. That's not so much something that's coming out of new standards. That's just a different way of looking at how we present our material to our funders. But if we start thinking now, take that same example, hold on to that. We're going to come back to that soon. I want to start using accounting standards to inspire us to some new ways of thinking about these things. One, I love to talk to people about this. Never let accounting standards get you down, right? We have to know enough about accounting so that we're never a victim of our accounting, and I say that a lot. So please, follow that thread through as we go forward. So this is actually a fairly detailed view of an accounting standard that came out recently, and it's mostly an update to some previous accounting standards. And I'm going to start with this. This is comes from FASB, the Federal or the Financial Accounting Standards Board, and they issue periodic accounting updates. And this one is actually I'm going to adapt this because this isn't actually really about the kind of budgets we're going to talk about in a bit. But I'm going to take the principles that we find in this accounting standards update and apply them to our budget writing. And really, the first thing they're trying to solve for us here is to make a determination about whether when you receive funding from someone, whether or not that funding is actually a contract or a contribution. Those two things make a difference at the beginning in how we would treat something. Now, I'm not going to spend too much time having you learn all the intricacies of the difference. Just know that there is, the new standards do set some guidelines around whether, and when we talk about a contract, we're talking about an exchange where a government agency or a funder is actually literally almost contracting with you to do a certain thing on their behalf. I mean, that's an oversimplified way of looking at it. But in that sense, what we're talking about there is whether or not this exchange was very directly asking you to do a specific thing on their behalf with third parties. Now, the non-exchange side, the contribution side, we're more familiar with in the granting world or the foundation world, where somebody gives you a large-scale grant to go do a certain thing. You've already laid out how you're going to do it. You're not so much contracting. They're not contracting with you to go do a thing. They're just supporting you in your work to go do it. So that would be the non-exchange side. So I'm going to use that difference, and we're going to then look at some other pieces of this accounting standard and apply it to a budget process. So next slide. So let's get creative with that accounting. And like I said, I mean the legal kind of creative that we're talking about here, right? But really, when I talk about the use of this accounting standard in a creative way, what we want to do is think about recognizing revenue, the way that we're going to be taught how you would recognize revenue for contracts, and build that into the way we're going to present a proposal budget. And I'll show you what the key piece of that is and how it gets to be useful for us and helps us get to a more flexible grant proposal budget. So this is revenue recognition, topic 606. If you're ever talking to auditors or other accountants out in the world who are presenting you with information about this topic, this is actually the process that would be used if we were recognizing revenue from a contract. And again, I'm going to tell you, we're not going to actually prepare and present a contract to a funder and have them fund a contract with us. Instead, we're going to use these same principles and build a more flexible proposal budget for a grant. But here are the 5 stages or 5 steps that are involved in recognizing contract revenue. 1 is you have to identify a contract. 2, identify performance obligations. 3, determine a price for that overall program or in this case, contract services that you would be providing. Allocate that transaction price out to those different performance obligations. We'll call those deliverables here in a minute. And then finally, recognize that revenue as you accomplish each of those program pieces or each of those deliverables. So we're going to build that kind of thinking, that 5-step process, into building a different kind of proposal budget. And we're going to call this one a deliverable-based proposal budget instead of a full cost proposal budget. And in this case, we're going to use the very same example. So this is a civic engagement organization, provides 10 educational workshops about city government, 2 guided tours of city council meetings. The budget asks for $100,000, and it's designed to fully fund the work. So some work had to be done behind the scenes to figure out how much money you needed to accomplish those things. But now, instead of going to a full cost budget where we have a line item by line item budget, instead, we're going to apply those 5 steps that would normally be used in recognizing contract revenue. We're going to apply those to this grant budget process. We're going to build a budget that sort of acts as if it's a contract. And the reason we want to do that is we want to deliver our program in a different way, not by line item by line item, not by salaries and occupancy and IT. We're not going to lay out those line items individually. We're actually going to talk about what it is we're going to do out in the world and build our budget around that so that our revenue basically releases from restriction based on what we do. So here I'm going to take those 5 steps and adapt them. Step 1, instead of a contract now, we're considering it a grant. So we just a grant agreement like you would have with any other funder that you're used to working with. But we've written our proposal and our narrative and our budget in a way that we're going to work towards this deliverable approach instead. The second thing we're going to do is identify those performance obligations. And really what I would call these are the deliverables, the thing we'd say we would do in our budget and our narrative. And you're used to writing your proposals this way, but now we're just going to call them out a little differently. So you notice when I gave that example, we had 10 workshops and 2 guided tours. Those become our deliverables. So now that we have those deliverables in mind, now we've already done the work to figure out what our transaction price is. Now there's a whole nother presentation we could make just at this point and talk about how nonprofits price their work, right? Now let's hope they at least did some work in the background like we did with that line item budget to come up with the full cost of what it would take to get this program piece done out in the world, correct? Well, that's good. Now we want to use that same work that we did on the financial side, making sure that we were covering our costs, to build that into a different way of building a different kind of budget and having it released differently. But we're going to use that same $100,000 figure. And then you see step 4 is allocating that $100,000 across all of those deliverables. So in this case, we figured out it's about $9,000 each for each of the 10 workshops. It's about $5,000 each for each of the 2 guided tours. Next slide. And then 5, that recognize the revenue when or as a performance obligation is satisfied. So that's the principle that comes out of recognizing contract revenue. I'm going to show you how we can actually use that to release revenue from restriction for a restricted grant. So here's that same program, that same dollar amount, pushed out in front of a funder, and obviously the relationship with the funder is strong, that they're willing to support your work in this fashion. But we have a good description of what goes on with each of those workshops. We have our 10 workshops laid out. We've attributed $9,000 each of the workshops, $5,000 to each of the guided tours, comes to the $100,000 budget total. Now what happens if this is our budget proposal, and this is our budget that we've presented to the funder, this becomes part of the grant agreement. I think we all know that a lot of times grant agreements that come back from a funder just reference the budget we've provided or reference the narrative we've provided, and that becomes part of the agreement. Well, if this is our budget, this is our agreement, this is now the restriction. So all we have to do is accomplish each of those things in this budget, and we get to release the money for it. So for each budgeted event that we provide and produce, once it's completed, we can release $9,000 of that amount for those workshops. The same thing with the guided tour. For each guided tour we present, once we've done all that, we've completed the work, we can release $5,000 of the revenue. Now, the key piece in knowing this, or looking at the budget this way, is that if we present the budget this way, we actually have some freedom to, if we actually did that work for less than $5,000, we could capture some of that surplus, and legitimately so, because we said we would do a certain thing, the funder agreed to fund it at a certain level, so we've met our restriction. And this is a great way for nonprofits to actually build in a true cost and more than true cost possibility for themselves to be fully funded in the work that they do. Next slide. So the beauty of this deliverable-based budget really is the ease of tracking it. The releasing from restrictions is much less cumbersome. You don't have your CFO or accountant inside your organization poring over every line item, trying to squeeze every last dollar, and trying to, you know how we sometimes try to get creative and push things into budgets. None of that's going on. We've actually just made sure that we built the budget so it had all the full costs that we needed to do this program work. And as we accomplish each of the deliverables, we have an incremental release, which covers all the direct program expenses, all our core infrastructure, any reserves we built into it, our pricing, if you want to think of it that way, but the amount of money we attributed to that deliverable. So it becomes way more flexible for us. I'm going to change courses and just use another set or another example to show you how accounting standards can be used to our benefit. This is actually going the other direction. There are occasionally those odd situations where we might get a large multi-year grant from a funder, and it turns out that having a lot of money from a funder in 1 year because of the sort of oddities and peculiarities of nonprofit accounting, we end up with a large amount of money showing up in 1 year that we have to recognize as grant revenue, and then the next couple of years afterwards, as we spend it down, our finances start to look a little skewed. And I'll show you some examples of that. So what we're going to talk about is the timing of unconditional versus conditional grants, which is different than restrictions, and I'll talk a little bit about that, and how they affect our finances. So here's year one of a large multi-year grant, and I've tried to keep this very simple example, so you know, you'll see that I have just the bare bones of showing you revenue and expenses for this mythical nonprofit. But let's say we got a $750,000 grant over 3 years, so $250,000 of that grant intended for each of the 3 years. In nonprofit accounting, we actually do have to recognize that full $750,000, assuming that the donor gave it to us as an unconditional grant. There was nothing standing in the way of it being given to us or that we had to do in particular to get all 3 years, except that 500,000 of that amount is restricted for the next 2 years. So we have to book all 750,000 as with donor restriction, and then you can see that we released 250,000 of it in this first year. So we're actually going to use 250,000 in the first year of this grant. And I have the without donor restriction column. That's actually the column that's most important for nonprofits and the place we should always sort of center to see how a nonprofit's really doing. But sometimes funders aren't as savvy as we would wish, or the donors who are considering our organization and reviewing our 990s or our audits. And they may not know there is really even a 2-column way of looking at our financials, and they may only see the total column. So in this particular year, it looks like a huge gain, right? We see, if you look at the total column, we have a $1.3 million revenue line item, $800,000 in expenses, and we have a $550,000 surplus, which is quite high. Let's go to the next slide and look at year two. Year two, you can see things look differently on the statement of activities. we don't actually show the $750,000 in revenue anymore because that was last year. Instead, what we see is just a release from restriction. So that's actually a wash in our total column, but we move it from the with donor restriction column into the without donor restriction column. You can see the negative 250,000 on one side, the 250,000 and the positive on the other. And again, if you have a savvy donor or a savvy investor in your organization, they can look at the without donor restriction column, make perfect sense of that, and see that for this particular year, you had a $75,000 surplus. A less savvy funder may, however, see the other side of this and see only the total and see a $175,000 deficit. Now that can be alarming to some folks, and sometimes it just takes a good bit of education on your part, but you'll have to communicate that to make sure that's not a problem. And then if we look at year 3, which is the next slide, you'll see that pattern continues. So here's again, we had year 3 is another $250,000 release from restriction. Again, if we're looking only at the without donor restriction category, that's a good thing. If we look at the total column, that ends up being a place where we can see $150,000 negative bottom line. And again, without a properly informed readership or a user of the financial statement, that could sometimes be a problem. So now let's find out a way to counter this. So let's go to the next slide. So like I said earlier, never let an accounting standard get you down, and learn enough about accounting so that we never be a victim of it. So what I just showed you is sort of an example of a large grant, which we would love to have. If we're not prepared for it or not able to communicate about it well, or frankly just don't want it to come in that way, we could end up being a victim of that success. So really, there are some strategies we can employ, and really, and in some ways, you want to see either side of this. We either want revenue to be recognized in a certain period, or it would actually be better for us and even out our financials if we were able to delay recognizing it. Now, I mean, the difference between recognizing is when it hits our books. Releasing is when we show that the restriction was met. And in the accounting world, those are two different things. Sometimes a subtlety that we have to do a little bit of educating ourselves to understand fully. But just to know that I'm talking right now about when is that revenue actually recognized? When does it show up on our books? When do we have to first post it as revenue? So donors can impose conditions, which are different than restrictions on our revenue. And if it's a condition, we don't recognize the condition until we've actually, or recognize the revenue until we have actually met the condition. So that same accounting standards update that I just talked about earlier, the 2018-08, gives us some conditions or some circumstances that would create a condition. And what I'm going to propose here is that if you get to know those well enough, you can actually develop your proposal budgets, and especially your grant agreements, in a way that you can choose when that condition is either met or not met, and when that revenue is recognized or not recognized. So just a quick thing on conditional versus unconditional contributions. For a donor to impose a condition, now again, this is different than a restriction. A condition is actually something you have to meet up front before the revenue is actually recognized. There's two things that have to be in place for that to actually be a condition. One's a right of return or release, meaning that if you don't meet this condition, that you'd actually have to give the money back. Or the second thing that also has to be in there is the agreement must include a barrier. And I'll tell you a little bit about barriers now. So just a quick introduction to barriers. There's three different things that can put a barrier in place that could provide a condition. I say provide a condition in the case you actually want to put conditions into your grant budgets and proposals, or especially into the grant agreement. Because let's take that $750,000 example we just talked about. What if you would rather that you didn't have to book all $750,000 in the first year? Well, let's learn a little bit about these conditions and these barriers, and see if there aren't some natural barriers that we could build into our budget proposal and the language there, and actually sometimes work directly with our funders to include them in the grant agreement. If we could do that, we could actually control that maybe only $250,000 of that $750,000 would be recognized in the first year. And then the next piece would be recognized the next installment in the second year, and then again the third. That would even out our financials, both in the without restriction column and the total column. And if that's important to us, if that's a strategy we need to employ, if we're watching other sorts of messages we want to be conveying out into the world, then maybe we want to do that. And here's how we would do that. We look at any of these barriers. It needs to be to be a barrier, it has to be either a measurable performance-related barrier, like you have to have met a specified level of service, like we're going to serve so many clients by this time, and if we do, then we'll recognize this amount of money. It could, I think a lot of people are familiar with this one as like a matching requirement. That's a barrier, meaning you don't get to book. For example, if a foundation gives you a matching grant of $50,000, and there's some matching contribution amount, like another $50,000 from some other source, from individuals or another foundation, until you make that match, until you get that other $50,000, you can't book this amount. But once you do, then you can. So you might build in a matching condition as your measurable performance barrier. The other thing that can be built in that provides a barrier is basically an agreement that they're going to limit the discretion you have on the way you do your work. So it might be like the fact that your expenses are limited to only qualified expenses, which means you have to show them, you have to show the funder that you've actually used this grant for only these qualifying expenses. And so you're going to have to substantiate that first before you can recognize the money. In some ways, that's almost acting like a contract. Not quite, but that's sort of the way it functions. You have to do the things first. You have to show you have all those expenses and the right kind of expenses. Then you can release or actually recognize that money by meeting that condition. Or it could be as specific as saying that we're going to hire certain specific individuals with this money. Well, until you actually hire that individual, you haven't met the condition and you can't recognize the money. And then finally, the last one is more just to say that there sometimes are conditions or barriers that are actually tied to the purpose of the agreement. Like if they've given you money to go out and do a certain kind of research, until you've actually reported back to them that research, those research findings, you haven't met the conditions of the grant, so you can't recognize the money. Now, this is different than just reporting on your general activities. So a regular interim or final grant report on just your general activities for performing a grant is not a barrier. That would not qualify. Or for example, a requirement that you perform an annual audit. Those are two sort of incidental. Of course, you're going to do them. They don't rise to the level of being an actual barrier. So that's it. That's my sort of primer on barriers and ways to set conditions. Next slide, please. So what we need to do now to use this is to sort of avoid that situation where we end up with either too much money showing up in a particular year, or flip this all around and decide you want to avoid all those conditions because you're afraid you would not be able to recognize some grant revenue. So it's that way you get to choose, right? We're just, as long as we learn these principles, we get to choose one side or the other of this equation. But what we do is we make sure that we're adding the right language to our proposals and to our agreements. So if you want to restrict, or I don't mean restrict, or to place a condition on your grant funding in your proposal, the way you would do that is to build this into your proposal language, and again, make sure that it's in the agreement language. And this is one of those great places where your relationship with your funding partners, especially grants administrators and program officers, give you the opportunity to control how these proposals flow into the grant agreements. Again, I think maybe the mantra through this whole presentation is just, we need to know enough and be conscious enough of how we're asking for money to not be victims of our own asks. So if I were going to sort of sum up sort of the principles that we've been talking about, I've given you sort of very specific things and 3 different examples of ways to use accounting principles, all coming out of new standards that we have coming out. So it's, in a way, I always want to say, FASB can be our friends. We never have to be afraid of FASB standards. We just need to learn them well enough to use them well. But the overarching sort of strategy I would use with those accounting standards in mind is to write the biggest possible proposals you can. Bring in full costs in whatever way you do that, either in full line item budgets that include all the real costs of running that program and in your organization. Doing deliverable-based budgets that are far more flexible and really where the key releases come based on you doing the work and in the way that you do the work, so in the deliverables that you naturally do. And then, of course, in that last example of controlling when you recognize the money. All of that is about how you skillfully craft your proposal narratives and budgets. And really what it comes down to is sort of the art of accounting that I love so much is be artful in what you ask for. I think our funders appreciate very candid dialogue about what we need to do things well. So asking straight up for what you need is always the best option. The conversations can come after you ask for the full costs. If there really is a funder you want to work with that doesn't go as far as you want to go, have that conversation, be an advocate for yourself and our whole sector around how we look at grant funding. Include in every proposal budget as much of your work as you can, and make sure your narratives tie the use of the funds to the way you already naturally do business. If we guide our proposal narratives and our proposal budgets to look the most like the work we already do, when we get money, even if it's restricted, it flows out the door to pay for what we're doing on a day-to-day basis in the most natural way. And also, finally, a great point made by one of my development officer friends in the Twin Cities area here, always write towards your outcomes. If you put your outcomes as the sort of key piece you're writing about in your budget narrative or your proposal narratives, and you match your budgets to make sure you're fully funding those outcomes, your work will be more flexibly funded, no matter whether you get restricted grant money or general operating money. Either way, you're going to be crafting those budget proposals, those narrative proposal writing in such a way that it works for you rather than against you. So really, shaping your ask, the place to think about this is learn enough about the accounting and that full collaborative process we talked about earlier, where everyone's involved, our finance department, our CEO, our development officers, our program officers, all working together to craft the most inclusive budgets possible. Be wary of restricting ourselves in the way we go about our work. Understand the accounting. And again, you may not have to be the accountant for your organization, but know that you do have to play a role in understanding accounting to be able to use it strategically. So we can't always just defer off to, oh, I'm so glad we have so-and-so here because they know all the accounting and I don't have to. We need to know how to use it no matter where we sit in our organizations, because we're part of that fully collaborative process. And finally, think about the different kinds of budgets that we could use, those full cost budgets, deliverable-based budgets, purposely placing conditions in a grant or making sure to avoid them so that we're never victims of when we get our money. We actually control when that happens. Because really, it comes down to we're the ones who set our donors' intentions and understandings, and that becomes the restriction on our granted money, our contributed money that we receive. So it's up to us to shape that ask and do ourselves a favor in the process.
Kurt, hi, it's Jean. I'm going to join you now. There are a ton of questions. First, let me just direct folks to that top resource, which is this content in article form. So that will be coming to you in the follow-up email as well. As many of you have asked, yes, you'll be getting a recording of this session along with the slides. We always do that at NPQ, so you don't have to wonder case by case. That's part of the value proposition. As many of you have said, an enormous number of people have written while you were talking and saying, I'm going to share this with my development director, with my board committee, et cetera. So we know that this is really content that, as you just said, is important across different positions. And as your first slide said, once we start working collaboratively, we can actually employ some of these strategies. And the other thing I like about this presentation, from my experience of it, is that it combines some reminders about best practice and options with some new potential strategies, right? So, and we have questions in kind of both buckets, I would say. So starting just with the best practice stuff, Kurt, you use the word timid at the beginning, and I love that word, that we are self-restricting, we're timid about asking for things that we need, we're timid about asking for full cost. But on a practical level, one of the challenges that comes up with that is I find that many organizations are essentially doing their budgeting and fundraising to their most restrictive funding source, right? So if they do have federal funding or government funding in particular, that has sort of shaped all of the way they do budgeting and fundraising budgeting. And so I just wanted to kind of have you speak to that in the sense that what you're suggesting, I think, in this content is that we might need to be situational in how we approach these things. And there are implications of that for how we interact across these systems, no?
No, that's a great point, and one I share. One thing I want to say is that I am always an idealist. I always want to push us places we don't go naturally, and in some ways we sort of I think, become victim to our own sense of the way the world is. I love pushing into that, but I also live in the real world, right? I've been a CFO for various nonprofits for 25 years. I've been a part of this budgeting process, worked very closely with the EDs and CEOs that I've worked with the development staff. So I'm not naive to the fact that there are certain funders that are quite restrictive in the way they make their funding available to us. I know that especially some federal, state, local, county granting agencies may be behind the times as far as sort of keying into what's most effective for nonprofit mission in the way that flexible dollars actually help us accomplish that. But I always think we should, okay, you know that reality. I'll grant you that, right? I'll give you the reality of that situation. But I think our job is always to first start with, like, here's the way this would really come to you. And we go to those same program officers that we know are not going to be able to change the way they give us the money. They're still going to require all the same line item restrictions. But guess what? Those folks who are our program officers at a federal granting agency or a grant administrator at the local city government office, they are going to be, the future decision makers in all these processes. Those people are going to advance. We have a chance to educate along the way and say, well, okay, here's what it really costs to do this, and you're only paying for this. This is going to be a hard place for us to stay and keep partnering with you to get this work done out in the world. So I never want us to back away from that challenge, but I think you're right. You've really identified that we have to be flexible and sort of look at this approach and figure out where can we best do it most strategically, most realistically, and sort of come up with a coherent fundraising plan. It's collaborative, like I mentioned, across all those different parts of our organization.
Thank you. Yeah, and also, again, staying in sort of the best practice part of this before we get to some of the new practice questions. You mentioned in full cost budgeting that you said never a zero bottom line. And we know that there are funders who aren't expecting a surplus. And you mentioned potentially building it into line items. Can you just say a little bit more about some of the strategy there? If I agree that I should never be submitting a budget that would actually truly yield zero for me, how might I do that if a surplus is not acceptable to the program officer?
Well, that's what and again, there's a reality that we sometimes have to deal with, right? And we all have our favorite funders and then our least favorite based on, frankly, some of their response to that very question, right? Can we actually present a real budget to them, or does it have to appear a certain way to satisfy their needs? But again, I never want us to be a victim of the way we think things are sort of prevailing attitudes out there. So I think if we go to funders and we explain to them that, we can even joke with them that I've been taught that anything with a zero at the bottom of it, there's some plug number up above. I've heard people say, well, there's a lie in here somewhere. If there's a zero at the bottom, there's a lie in this budget somewhere. That's right. So I think if we go to our funders, and again, your enlightened funders, the folks who know this already, this isn't even an issue. But the other ones, we have to do a little bit of education. And then, frankly, they may come back and say, yeah, sorry, thank you for your idealism, but no, you got to come to this place. We actually get to choose then, do we need that money? Or can we go there in our budgeting and our financial strategies without harming our own organization or not? And I don't mean to make it sound like we're just going to all strike against all the money that requires that kind of budgeting. I don't intend that. But we do get to be thoughtful about it.
That's right. Thank you. So let's move to some of these new strategies that you're proposing, especially post these FASB changes. One of the things that's coming up is folks are saying that even when they have been able to get to kind of a deliverables-based budget, actually this is kind of a hybrid of best practice and new practice, even when they have been able to get to deliverables-based budgeting to some extent, their auditor is still requiring that full recognition of those restricted funds, in that first year. And you talked about the distinction between recognition and release. Say a little bit about how we might be negotiating with our auditors who may still be imposing that, even if we were able to get to deliverables. In other words, these people want to release as they deliver, not differently, right?
Yeah, and let me ask a clarifying for a point of clarification on that. So when you in asking the question, are you saying that when is this the case where we have a multi-year grant and we're trying to basically meter out when that gets recognized or when it gets released? Or do you mean in building a deliverable budget that auditors are coming back and saying, well, yeah, that's great, those are your deliverables, but I'm still demanding to see a cost-based way of coming to those numbers? Two different questions. I'm not quite.
Yeah, let me, we have so many questions along that line, so I'm going to go to one specifically.
Okay.
Because people are asking it in a number of different ways. Okay, so here's how one person has worded it. We have a couple of foundation grants that do have deliverables attached over a year, but our auditors require us to record them fully as revenue when received. This sounds like I should be able to recognize as delivered. Is this just about how we create the agreement?
Yes, so that's actually a great question, and it's sort of blending those two things, which
exactly.
Yeah, so correct, if we build a deliverable-based budget and we don't actually build into the grant agreement any sort of conditions, meaning it really is just a restricted grant that comes in, say the example I gave, where it's $100,000 comes in for that civic engagement project. Well, it's actually not a contract, it's a grant. And so I do have to show all $100,000, I have to recognize it as restricted revenue. Because there's no condition. I just said I'm going to do these things and here's my deliverables, but I didn't say that, we didn't build into the agreement a condition that I had to do the deliverable first before I recognize the money. I just built in the deliverable that's when I get to release the money from restriction. And I realize that can be confusing for folks, the difference between recognizing money and releasing money. Now, you could go so far as to build the budget and the proposal narrative even more in a more defined way that would actually build conditions into it, where it would say, like, we wouldn't get the second year's amount of money for this project until we completed the first 5 workshops. Now, that's a condition. There's a measurable thing that says you're going to complete 5 of them first, then we'll give you the second amount of money. Then you would only recognize $50,000 until you got the first 5 workshops done. So it's really playing with the difference between a condition and a restriction. And there's some gray area in there. The new standard actually says if there's any ambiguity, they're going to lean more towards condition than restriction. So be careful, don't build in conditions that you don't want to be in there.
Would you recommend, again, as always, you're making the, I think, proper distinction that it's not all funders. That, there's some funders who you can talk this way with. There's some funders who will know what you're talking about if you talk to them this way. Are you suggesting that with our more closely held enlightened funders that we would talk openly about using condition as a strategy?
Yeah, absolutely. Because I don't think they intend to put us in any awkward position in our financial reporting. For example, we have, I've been in a number of organizations where we've got large multi-year grants, sometimes a couple of them at a time, and it really skews the financials. Because we may show on the total column, we could show as much as $1 million or $2 million surplus in the first year, and then over the next couple of years, as you spend those down, you're showing very large deficits in the total column, right? Well, I think most of those funders, they're savvy enough that they're not going to react to that. They know nonprofit accounting, and they can live in that without restriction column. But many funders, the other folks we hope to attract, wouldn't get it. They would see these large deficits, take alarm. If they're just comparing us to some other organization on the surface, they might choose the other organization without digging in deeper. So those funders are sort of more natural allies who get all of this. I think they'd be amenable to saying, sure, let's build in a condition that says this. We have to meet these things first, and then it's not releasing. They're going to recognize and give you the second installment. So the second year won't come until those conditions are met. It just controls
really interesting.
Yeah,
that's right. Well, but to your point, that's huge. And it's not, I guess, from my experience in leadership too, it is about optics, but it's also just about the way it actually feels to manage that money. So yes, it's about the optics of the total column, but I also think it can feel, what you're proposing could create a situation that feels more natural in terms of how we're managing that money, how we think about it hitting our operations.
Right.
We have another question. Go ahead.
Sure. No, go ahead.
and this may or may not be in your wheelhouse, but there's another question about large multi-year grants. This person asks, they're an issue for us, not because our stakeholders don't know how to read financial statements, but because of the public support test. And so she's wondering if you might have any comment on whether imposing conditions to spread grants over multiple years could help or hurt our public support test kind of assessment.
Well, it's certainly a great lever to play with, because if you do meter out when that money actually is recognized on your books, it would spread out over a multi-year public support test, right? So if it's a $1-year $1 million grant spread over 4 years, ends up sort of diffusing its effect across a number of those public support tests. Now, it's a 5-year look-back period, so it won't go away completely. But the other piece about that I just want to say out loud, it's a totally different topic, but related to that question, is that there's a sometimes not well-known provision in the IRS guidance around that public support test that says you can exclude unusual grants. Meaning if you have a grant that is unusual, meaning like you don't normally get, $2 million grants over a 3-year period, you're used to getting, $50,000 to $200,000 grants. You can actually exclude that, because that one grant in and of itself would push you out of compliance. So the IRS is savvy to the fact that, they're not going to penalize anybody for a rare one-time occurrence. That's another, I just want to say that's a piece of accounting, not related to our topic today, but might also apply to that question.
Right. No, absolutely. And let's maybe close, because the thing that I think is brand new for many of us is to actually impose conditions on ourselves, right? That's the tactic or the strategy that, we're all walking away with like, wow, that's interesting. And I'm starting to see potential benefits of that on a couple of different fronts. So if we could just make sure we understand this, you talked about, can you go back to the notion of a milestone barrier? Let's just go back to that. Let's close with that vocabulary a little bit on sort of the core types of conditions.
Right. Milestone barriers are those that sort of, they're the ones that are going to allow that recognition of the revenue, the condition to be met in piecemeal. You'll hit sort of it could be a threshold for a number of clients served. If you're providing affordable housing units, it could be a threshold that as the number of housing units that are made available for rental, if you hit, the first 50, a certain amount of the money, or, you hit the first 50 and it basically allows you to recognize the second installment of that grant. Those can be built in. So they're milestones, meaning that it's not a one threshold only. It's sort of metered out. You have to hit things along the way. So that's what the milestone means. And that's another great way to build the barrier to sort of match how you expect to do your work. So you don't want to shoot yourself in the foot with a condition and make the money, too hard to get to. You really would, the art is trying to match those conditions to the pace of how you actually do your work.
Right. Okay, and I would direct people back again. You're going to get these slides, but you had 3 different kind of types of conditions: the measure of performance, a stipulation that limits one's discretion, and then the extent to which a stipulation is related to the purpose of the agreement. Correct. I think another insight here is you've mentioned a couple of times that it's not just the proposal, it's the agreement, and I think many of us haven't even really thought about negotiating the agreement. Can you just say a little bit more about that process-wise?
Yeah, I think, again, this is, these are folks to have relationships with, and I think we all know that a key piece of successful fundraising is to start with a good relationship with any of our funders and investors, correct? But so it's really those human beings that are on the other side of this want our success too, and they don't mean to inadvertently limit or sort of diminish our success by something that's just like standard language in an agreement. So I think all those things can be negotiated. But the point is that those things become binding, and often they refer back to how we asked for the money. So let's make sure we ask in a way that's the most flexible, fits our programmatic needs the best. But then also let's go as far as the agreement, because the agreement could be very simple and just say, yeah, look at those 2 documents, or it might have all this other language in, like a right of return, or it might actually spell out those conditions. Let's make sure that we read that carefully.
Yeah, and it's, our auditors do look at those agreements. We may not.
Oh, yeah.
I remember as an ED, I just signed them, right? They were just in my to be signed folder. I never once thought about them as like a strategic choice point, because I think we think of it as, well, it's done. I submitted the proposal, and so the agreement must reflect that, and or it's non-negotiable. But of course, auditors do look at those agreements as they're kind of getting into the nuance of the choices you've made about recognition and release. So that's just such a huge tip, to look at both sides of that, the proposal and the agreement. Can we go back to the resource slide before this? Again, just to remind you that Kurt's work, I think your title is Director of Nonprofit Innovation. This is a thought leadership role, and there's lots that you can look for at CLA, and also look for Kurt's work at the NPQ site. And we can go to the final slide now. Thank you all for your engagement. It's wonderful to get so many questions, and as I said, to hear how many of you want to share this content with your development staff, your executive staff, your board staff. That's where Kurt started, that we all have to be involved if we want to be strategic. So I'm excited that we brought this today. Kurt, thank you, as always, for translating ideas into actual content and concepts that we can apply and experiment with. We appreciate you.
Thank you. It's a pleasure. It's a lot of fun. Can't wait to hear from folks. So.
Okay. Thanks, everybody. We'll see you next time.